Good morning, folks, and here's to another edition of our weekly wrap. And today I have with me our research analyst and family office analyst Vishnu Shastri.
Happy to be here.
Okay, so he's going to be giving us company and discussing all the hot topics of the week. And believe me, there are some hot topics this week around. Okay, to kick off with, I'm going to pull out a chart that is there in the ET Wealth. Okay. And every week, ET Wealth comes out with something called a trend map. And it talks about long period trends among asset classes or markets. Extremely interesting. Each of them have multiple stories that they can talk about. Right? So this time, the trend map is about returns from different countries across the world. Okay, it includes developed markets and emerging markets all put together across 10 years from 2016 to 2025 year to date, calendar year to date. And believe me, there's so many stories that can come out of this. But today, Vishnu and me are going to focus on one such story, and you'll be surprised with the ending. Okay? So this is returns from equity markets of Brazil, US, Germany, Japan, Hong Kong, India, UK, Mexico, and China. All these countries, and these are as diverse range of countries as you can get. All the returns are in rupee terms. Okay? So here, the 10-year return of so there's a table here, and the topper for the 10-year return is not America, it is not India, it is not China, it is Germany. The German DAX has given a CAGR of 12.7% compounded over the last 10 years and year to date. Nobody thought of that, right? But there it is. Okay, and it is followed by India's Nifty at 12.1%, then Brazil at 11.7%, then the Japanese Nikkei at 11.2%, and then the US's New York Stock Exchange Composite at 10.9%, and then followed by UK, Mexico, Hong Kong, and China at the bottom of the league table as far as the 10-year return is concerned. If for some reason ET Wealth has chosen to take the US's NYSE Composite, but if you were to take the S&P 500, then the league table would change, and following Germany is the US at 12.6%, and then India at 12.1. So they're all pretty close. Germany, US, and India at 12.7, 12.6, 12.1%. Okay. So that is a 10-year CAGR. But if one were to look at each calendar year returns, would you believe it if I said that Germany features only once in the top table? Okay, it was in 2019 that the German DAX returned at 26% and featured at the top of the table. And after that, or before that, it has not featured at any time. So somebody that has only had one great year has become a 10-year CAGR. Okay, the most frequent occurrence at the top, at the number one slot in the calendar year basis is Brazil. It occurs 4 times in the number one slot. Okay, yes, 2016, 2018, 2022, and 2023. Okay, and in the year to date of 2025, it's at number 2. But in the league tables, it's at number 3 or number 4, depending on which index you take. Okay, so somebody who has been there number 1 most frequently doesn't feature in the 10-year CAGR number 1 at all. Isn't it strange? Germany, which is at the number 1, is only once top ranker in 2019, but it features at the number 3 slot at 1, 2, 3, 4, 5, 6 out of 10 times. It features in the number 3 slot. What does that tell us? It tells us it is not necessary for a long-term winner to be number 1 all the time. It needs to be consistent. So Germany has consistently been there at the number 3 slot. And when it's there, it means it's not going up too much, nor is it falling too much. And remember, if something falls too many times, it's much more difficult for it to recover. And that is why the number 1 Brazil slot, which was 4 times in the last 10 years, also fell so many times. It had a difficulty in giving a 10-year compounded return. So remember, consistency is a key. Doesn't matter if it's not at number 1 consistent, not at number 2 consistent. Even a number 3 consistent player can become the 10-year number 1 winner. So even when you're choosing mutual funds, remember, it is not important that it be the number 1 player all the time. It focus on the consistency. As long as it is in the top quartile or even in the top 2 quartiles, but consistently there, you have a winner on your hands. Okay, that's all you need to be focusing on, folks. Now, another interesting article here in today's ET Wealth, and that's about, guess what? IPOs. Vishnu, what do you have to say about it?
So, sir, yeah, this year is looking to be a very interesting year for the IPO market, with so much as 90 stocks having their debuts in this year itself. But then, in such a vibrant environment, we should also be aware that not all IPOs are always going to benefit the investor. The picture is not always rosy as it seems. If I were to give an example, the latest IPO, which is coming up, in fact, is actually had its day one, is Lenskart's IPO. Lenskart has aimed for a ambitious valuation of 70,000 crores. But then what's interesting is just in the month of July, Lenskart's private valuation was just about 8,700 crores.
Oh.
So the jump has been about 9 times in just a matter of few months. So some things like this should be studied with greater focus, because as an investor, what might happen is that we would just see the overall valuation of the company and go right ahead. We should also see the underlying business, what's happening. And in such an environment where there are 90 stocks, a lot of the investors are indulging in what is called as an IPO flipping, where they jump from one IPO to the other right away and try to make listing gains. But while investing, we should also be mindful of our exit strategy, because in an environment where there are IPOs like LG having good listing gains, there are also IPOs like Ola Electric where the gains are not very high, and in fact the performance is quite bad.
Yeah, I think point is right. What has been happening in the all the IPOs that have been coming, or the bulk of the IPOs that we have seen over the last couple of years, a number of private equity funds are exiting their stake to the public through an IPO. And not all the money raised from the public hence is going to the company. As an investor, I would like to see that my money being invested in the company and not to provide an exit to somebody else. Number two, the private equity player is obviously looking to his own gain and offloading at the maximum possible valuation, which need not be a fair valuation. As Vishnu pointed out, hardly 3 months back, there was a buyback at Lenskart, and that buyback happened at 8,000 crore valuation. And the IPO is at almost a 70,000 crore valuation. So it is for y'all to judge which was the fair valuation out of that, the 8,000 crore valuation or the 70,000 crore valuation. So before putting your money into the IPO, please dig deep and don't fall prey to crazy valuations. Okay, so that's what I have to say. Moving to Thursday's Mint. Okay, there's been some good news, by the way. We've been speaking about CapEx for so long. I do not know, I've lost count in how many weekly raps I've spoken about CapEx not matching up to expectation. But the numbers that have come out this week are pretty good. So we have two different reports, one in Business Standard and one in Mint. So the Business Standard speaks about private CapEx coming back, and Vishnu will speak about the data that is out there. And the Mint speaks about Larsen & Toubro's order book. So the L&T is like a bellwether as far as infrastructure is considered, just like we have Infi or TCS as bellwether stocks in the IT segment. L&T is the bellwether for infra and capex. And in its recent results, L&T does state that their order book has jumped 50%. Okay, and the domestic orders now are more than 20,000 crores after 5 quarters. Okay, so that is definitely good news. Okay, these orders are not just from government spending, they are also from private spending. So it's a good mix. And what is it that we can expect out of private spending? I think Vishnu can talk to us about what are the orders that are coming in. These are capex commitments, they are not capex orders, let us be clear. Yeah, Vishnu.
So yeah, as sir pointed out, the private sector is picking up its share of the capex investment. In fact, if I were to quote some numbers, the second quarter of FY 2025-26 itself has seen a huge jump in new projects, about 10.5 trillion rupees in 1,800 projects. Compared to last year for the same time period, it was only 5.69 trillion rupees. And also, speaking about the share of the government and private sector spending, in the second half of FY25, while the private sector spending was only 61% and the government was doing a lot of the heavy lifting at about 39%, the private sector spending has now increased to close to 71% and the government being at 29%. So this is a huge change in trend what we are seeing.
Let's hope it keeps up and this really happens. Okay. The Thursday's Mint has a headline, they have a long story inside. It says, could the rupee see a hasty slide to 100? Okay. And this has been on top of a lot of people's minds. Is the rupee depreciating too fast? And oh my lord, is it going to be 100 to a dollar? Correct? Is that good or is it bad? Can it happen or can it not happen? But all this while we've been speaking about the dollar weakening. Okay, the dollar index measured by the DXY against a basket of its large of the large currencies. DXY has been falling. It had gone up to 113, even 118 if I remember right. Came down to 94 and now it's at around 98, 99, edging up again. So if the dollar had weakened, the rupee should have appreciated against the dollar, is it not? But no, it did not happen. While the pound sterling and the euro appreciated more than 10% against the dollar, the rupee depreciated against the dollar. Okay. So this is surprising, but to say the least. Why did this happen? If we are saying that the dollar weakened, we are much weaker. We say that our country's macros are strong. So why should it have weakened? Inflation was not strong. Inflation has been very much under control and below expectation, in fact, in spite of which the rupee has weakened. So it seems that the real culprit is not the country's macros or the current account, correct? But definitely, the culprit has been flows.
I totally agree.
Yeah.
While earlier also, when our current deficit was high, we had the inflows in the form of FDIs, which were there to counteract this effect, and the weakening of the currency was much controlled, I would say. But this year, what has happened is that the FDI outflows are far greater than what was seen in the previous years, and at the same time, the FDI inflows has reduced. So due to this, the current account deficit, what is present, is not getting completely set off by the FDI inflows, net inflows, I would say.
Yes. So it's not that we've not had FDI inflows. FDI inflows have been at around $29 billion, but the net flows have been very low. So what's happening is a number of private equity players have been exiting their positions in the Indian public markets and repatriating the money back. So we are having outflows. While we've been having inflows, we've been having considerable outflows. Along with private equity players taking their money out, it also so happens that a number of Indian companies have begun to invest outside India. So there's an FDI outflow also in both these terms. And we all know how FPIs, that is the foreign institutional investors, have been behaving. So in the last 1.5 years, they've only been pulling money out. Almost 2.5 lakh crores or so has gone out of the Indian markets. So net FDI flows being hardly a few $1 million, and FPI flows going out, that has put a strain on the rupee. So it is not the country's macroeconomics or inflation, but it has been simply supply and demand, inflows and outflows, which have determined the strength of the rupee, or rather the weakness of the rupee in this case. Okay. And so, are we going to touch 100?
The question is when we are going to touch the 100, sir. Because while the currency depreciation of 3 to 4% persists, we would be touching the 100 mark in about 5 years. The real question is whether we would be touching it rapidly. And the answer to that is no, unless a very significant event happens, like the entire trade negotiations collapsing itself, which is highly unlikely. Something like this would not happen. And also, the government and the authorities have taken significant steps and introduced a lot of reforms. 3 of the major reforms, what I would like to note, is that the RBI has relaxed the norms on ECBs, which are external commercial borrowings, and the authorities have allowed foreign investments in the banking sector, which was stringent earlier, and also in the trade amongst countries, there is a promotion of accepting rupee as the form of payment, which is also factoring into strengthening and providing a stable base for our currency.
Yeah, you're right. So the last one, where the rupee is being promoted by the government for trade settlements, we tried that out with Russia, of course, and we're trying to convince Saudi Arabia to use rupee as trade settlement instrument. Let's see how successful that is. I'm not too gung-ho on its success, but allowing more external commercial borrowings by companies, that could help ease flows. Okay. But even with this year's weakening, have we weakened more than the average annual rate? No. Our average annual depreciation has been around 3% in the last few years, and before that it was 4%. Okay. So we have not gone beyond that. And even if we assume that the same 3% depreciation will happen, we will touch 100 in a few years' time, 5-6 years' time. That's bound to be. Is it bad? It is not bad for the country. Remember, for an exporting nation, a weaker currency is to our benefit. So on one side, if we have tariffs imposed by the US, what is the counter to that? Weaken the currency and try to offset some of the tariff cost with a weaker currency. So it's actually not bad to have a weaker currency while having a strong macro. That's where I'd also like to pull out an article from last week's ET Wealth. In fact, we had spoken about it, and this was about mutual funds. Do we have an over-diversified mutual fund portfolio, right? And the point that the article made out there was that there are a number of large cap funds which have very similar portfolios, what they call an overlap. Okay. And what the article advised readers was that if you have mutual funds with very similar portfolios, then why at all have it? Because you're not getting diversification. On the face of it, yes. But then I did ask Vishnu to take a deeper look at this. What did you find, Vishnu?
So yes, what we did was, first we took 5 of the top large cap funds, and then we analyzed their holdings for the past 10 years. And what we found out is that about a decade ago, there was an average overlap of about 55% in their top holdings. And then this number shot up to somewhere between 63 to 64% in 2022 and 2023. And right now it is somewhere between 60 to 61%. So while the overlap is huge, but the returns vary vastly amongst these funds, with some divergence even going in the double digits in terms of percentages. On an average, the divergence in the returns of these funds on a 1 year basis has been about 5 to 6%.
Oh, wow. So what it seems to be saying is that while at any point of time there may be a 50 to 60% commonality in holdings, the performance is not similar. The performance can vary a lot. So in any given year, you could have even a double-digit difference in performance between Fund A and Fund B, even though at this point of time they have a similar portfolio. So it doesn't necessarily mean that if you're having a similar portfolio at any point of time, the performance was also similar. These are all actively managed funds. So the active fund manager is clearly looking at when to enter a stock and how much to enter a stock. So in these decisions, two fund managers could have very different perspectives. Though they may end up having a similar portfolio at a later point of time, the path taken to that is very different. And that is what results in a different performance metric when you're analyzing it at different points of time. So do bear that in mind, folks, when you're looking at mutual fund portfolios. So that's all we have for you this week. I hope you have enjoyed and found our weekly wrap useful. Have a good weekend.
Thank you. Have a great weekend ahead.